Right now, gold's at a price of $4,300 per ounce. Everyone's in. Your colleague, your driver, your barber, your friend, your uncle, even the Bitcoin bros who used to laugh at metal are now shouting gold to the moon. They think it's the ultimate protection, the ultimate inflation hedge. But what if I told you this is the biggest bubble since 2008? This isn't a hedge anymore, it's a trap. For at least for some time, until a correction. And the clock is ticking down to a catastrophic crash. I'm about to drop 8 shocking, undeniable reasons why gold crashes 20 to 30% by mid 2026. This isn't just a correction, it's a plummet. We'll expose why Wall Street insiders are already dumping and running. The secret truth that central banks have stopped buying. The definitive sign that social media is calling the absolute top. Why governments hate gold hoarders and are prepared to act. And why US stocks are suddenly screaming, "Buy me," as the only true value left. Plus, we'll deep dive into the duopolar war, the dollar versus gold split that is literally dividing the world in two. This geopolitical seismic shift is the final catalyst for the crash. If you're watching Zalwora, you're here for the truth and the profit. Stick around. Hit that like button now if you smell trouble brewing and want to protect your portfolio. Because in next few minutes, you'll have the battle plan to survive the gold crash 2025. Social media is blowing up with warnings about gold. The price keeps shooting up, but a lot of people who watch the markets closely are saying this could be the top. Big traders and hedge funds are starting to pull out. Short positions are stacking up fast, and it looks like retail investors are rushing in late, driven by hype and FOMO. Posts are going viral with charts, data, and bold claims that this rally might not last. Some are even calling it a repeat of past market crashes. All signs are pointing to a classic bubble, and when that pops, things can get ugly fast. Even Bloomberg admits it. Gold's rally losing steam as dollar rebounds and risk appetite returns. They are talking down the price. And get this, the Instagram finance gurus are flipping their script. The insiders know something you don't. They are not waiting for your confirmation bias. We track the social sentiment score across dozens of platforms. It went from a euphoric 87 out of 100 bullish to a dangerously low 43 out of 100 bearish in just 3 short weeks. This isn't retail noise. This is the smart money exiting stage left. And if you don't follow them, you're going to be the last one holding the bag when the music stops. Let's get into the charts. This is reason number 1, and it's the most fundamental. Look at this beauty. Gold 2020-2025, 190% rocket ride. Our last 5-year return is 128%, a breathtaking parabolic surge. But parabolic moves have only one ending, a crash. This is a mathematical certainty. Here's the historical math you can't ignore. Dot-com bubble. Nasdaq crashed minus 78% after its parabola. 2008 housing crisis. Gold corrected a sharp 30% post-peak, even with the world burning. 2022 cryptomania. Bitcoin crashed minus 75% after mooning to its high. 100% gains in 5 years equals a 20 to 30% correction guaranteed. The market needs to cleanse the excess, wash out the weak hands, and reprice. Where are we now? Right now, RSI equals to 82. That is extremely overbought. Anything over 70 is a warning. This is a 5-alarm fire. MACD equals to bearish divergence. The price is higher, but the momentum is lower. That is a classic reversal signal. Volume equals to drying up fast. The big money isn't supporting this price anymore. Let's look at the historical precedent. 2008 gold peaked in July, crashed 30% by October. That was a 3-month liquidation event that wiped out fortunes. Our prediction is clear. from $4,300, we expect gold to slide toward $3,200 to $3,400 by Q2 2026. That's a potential 20 to 25% liquidation. US investors, do you remember the 20% crash back in 2022? This one could be even bigger. Across the Middle East, GCC sovereign funds are holding record levels of gold at peak valuations. We are now in the danger zone. The higher you climb, the harder you fall. This is reason number 2, the asset saturation problem. Gold isn't a new technology. It is a $30 trillion mature behemoth. It's been trusted for thousands of years. The question isn't, is gold good? The question is, who's left to buy at $4,300? Let's break down the fan club. Pre-2020, 70 to 80% of conservative investors already trusted and owned gold. 2020 to 2025 rally. The panic and inflation fear drove an additional plus 20 to 30% FOMO buyers into the market. Today, we are at 95% plus saturation. Nearly everyone who wants gold has bought it. Contrast this with the Bitcoin story, a $2.5 trillion toddler. Only 20 out of 100 people worldwide trust BTC right now. Its community can 5x easily as adoption grows. The gold problem is fatal. No new buyers left to sustain this price. The buyers have all been flushed out over the last 5 years. The flip happens when the new recent FOMO buyers dump first to lock in small profits or cut massive losses. The social proof confirms this saturation. The Google trends like buy gold searches peaked 3 months ago and are now declining. The retail herd is already in. The assets under management are flattening. Zero fresh institutional inflows. What about jewelry demand? China and India, the world's biggest physical buyers, are significantly slowing their purchases due to the high price. Now, Middle East reality. Sovereign funds are maxed out on their commodity allocation. Retail, they are already heavily invested via the Emirates gold souks and jewelry stores. There is no one left to prop up this price. Now, let's pivot to the grand chessboard. This isn't just about charts, it's about control. It's about the duopolar war, dollar versus gold. Dollar's cracking empire. The US dollar's reign is unparalleled. 80% of global trade is still priced in USD. It is the bedrock, but the foundations are cracking. BRICS Plus is now a powerhouse, accounting for 45% of global GDP, officially surpassing the G7. They want out of the dollar. Russia's SWIFT ban was a wake-up call for every nation. Your dollar reserves are a liability. The ultimate threat. Saudi Arabia is actively considering yuan oil sales. That is the end of the petrodollar and a massive blow to USD demand. Gold's Eastern power grab. Gold's recent run wasn't driven by US inflation. It was driven by these nations hedging. Central banks bought a historic 4,800 tons. China, the undisputed number one buyer, with 2,200 plus tons added. They want their currency to be gold backed. Russia, a top producer and reserve holder, using it to bypass sanctions. India, diversifying fast to protect its massive population. Gold hit $4,300 because it hit peak panic. The market priced in the complete and total collapse of the US dollar. But that assumption is wrong. The dollar is not collapsing, it is fighting back. Rare earths equals to new oil. The ultimate weapon isn't gold or oil. it's the ingredients for the future. China controls 72% of the world's rare earths, the new oil. EVs, iPhones, missiles, fighter jets all need rare earths. The US imports 80% of its rare earth materials from China. Export bans are the ultimate weaponized sanction. The reality is a duopolar world. West, USD plus technology plus deep capital markets, versus East, gold plus rare earths plus oil. Gold's job is done. It was the hedge. Now the capital is flowing into the real strategic assets. This is reason number 3, and it takes the wind out of the entire gold bull case. Gold's rocket fuel for the last 5 years has been one thing: central bank buying. Look at these volumes. 2021, 410 tons, sluggish. 2022 to 24, a massive record-breaking 1,150 plus tons annually. What about 2025? The central bank buying is already half stopped. The fuel gauge is on empty. Why? Because the diversification mission is complete. They have the reserves they needed to hedge against dollar risk. China, loaded up. Russia, fully hedged. India, sufficiently diversified. They don't need to panic buy at $4,300. They accumulated at much lower prices. History lesson. This happened before. The 1971 Nixon shock. The world ditched the gold standard. The world realized the USD was simply easier to trade and manage. The danger now is a complete reversal. What if China dumps gold? They could sell their reserves to fund a strategic play. A massive silver play to control industrial metals. A coordinated Bitcoin bet to destabilize the US financial system. Or, worst of all, rare earth weaponization backed by a gold reserve. The minute these central banks step out, the liquidity evaporates. Commodity volatility equal to price collapse loading. You cannot afford to be in the market when the biggest buyers turn into sellers. This is reason number 4. It's about opportunity cost. Money rotates like a clockwork mechanism. It always flows from the expensive to the cheap. Gold is called expensive, and the US markets is called bargains. Look at the valuations. S&P 500, trading at 20.5x PE versus its 32x peak in 2021. That's a massive discount. Small caps, Russell 2000, 12x PE, historically cheap. This group is due for a massive 50% mean reversion rally. Russell 2000, currently trading at its biggest discount relative to the S&P 500 since 2009. The gold to equity ratio is the ultimate tell. We are at 2.7 versus its 3.2 peak. A high ratio means stocks are undervalued relative to gold. Market chatter confirms a major rotation. Investors are moving out of gold-focused funds and shifting into beaten-down equities and energy stocks. Analysts note that gold now looks expensive, while tech appears undervalued, suggesting the easy money in metals may already be made. The question for you, the astute investor. Why chase $4,300 gold with zero yield when the S&P 500 gives 15 to 20% upside and a dividend? The smart money has already moved on. You need to follow their lead. 3 more reasons. The market is screaming at you. Number 5. Retail FOMO equals top signal. The oldest trick in the book. When your driver, barber, your friend, uncle or your colleague, everyone around you talks gold, that is the time for you to start selling. Google search on buy gold is peaked globally. Number 6. COMEX shorts exploding. The most important data point. The COT report shows gold shorts are at 3-year highs. Big banks and market makers are betting against gold, using their deep pockets to initiate short positions. Hedge fund short positions are near record highs. They are ready to crush this price, and you'll be on the wrong side of the trade. Number 7. Technical breakdown loading. The chart is talking. $4,300 equals major resistance. We failed to break it decisively. The next major support is the 200-week moving average, which sits right at our target of $3,200. Fibonacci retracement. The crucial 61.8% retracement level lands squarely at $3,100. The math is terrifyingly clear. This is the final reason, and it's a political reality. Governments love trading, but they hate hoarding. Now, problem with gold. It is dead money from a government revenue standpoint. Physical gold generates zero taxes until it is finally sold. It sits in vaults and generates no economic activity, no employment, and no growth. Stocks or equities equal to tax machine. They generate revenue at every turn. Capital gains taxes when sold, transaction fees, dividend taxes annually. Government nightmare. Capital flight to gold means their tax base shrinks and markets freeze. They will not tolerate this for long. The US of Fed solutions are historically brutal. They could tax gold transactions heavily, reducing its appeal. They could even invoke the 1933 precedent, gold confiscation. The government can literally demand you turn over your physical gold for a set price. Prediction. Gold must correct so that the government's preferred engine of growth, stocks, can shine again. The government wants your money in their ecosystem. A high gold price is an economic rebellion, and they will crush it. You have the warnings. Now you need the plan. Here is your Zalwora battle plan to protect and grow your wealth during the gold crash. Stop doing this, buying gold at $4,300. You are chasing the tail end of the bubble, stopping stock or bond investments. You are missing the massive rotation into cheap assets. Holiday gold splurges. Your family might enjoy it, but your portfolio won't. Do this instead. Wait for the 15 to 25% dip, $3,200 to $3,400. That is your entry point, not now. Target US small mid caps, the undervalued gems that will explode higher when this rotation takes hold. Focus on GCC dividend stocks. The steady cash flow and low volatility will weather this crash. Trade gold, don't hodl. Use small positions to short or buy inverse ETFs, but don't hold the physical metal. Portfolio allocation. Shift to 60-30-10 stocks, bonds, commodities, and cut your gold exposure. 6-month targets. Gold $3,200 minus 25%. S&P 500 6,500 plus 15%. Dollar index DXY 110 strengthened significantly. Protect your wealth. The data is clear. Don't be a victim of the gold bubble. Gold crushed everything for the past 5 years, but the party is ending soon. The music is stopping and the insiders are heading for the exits. Like this video right now if this analysis saved your portfolio. Subscribe to Zalwora for weekly market nukes and deep dive analysis. Comment below. Type gold bubble if you are awake and ready to profit from this crash. Thanks for watching.